Getting a big grant of company stock, RSUs, can feel amazing. It's a huge part of your compensation package, and it means you've got a real stake in the company's success. But let's be honest, it also brings on this giant wave of anxiety, right? Especially around tax time. There's this nagging fear that you're going to get hit with a massive, unexpected bill, or even worse, pay way more in taxes than you actually should. Well, today, we're going to demystify all of it. Okay, so let's just rip the Band-Aid off and dive into the one question that's on everyone's mind. Are your RSUs really taxed twice? You hear this all the time, and it causes so much confusion. The short answer is, kind of, but not in the way you think. You are not taxed on the exact same money twice, but you are taxed at two totally different moments in time. And understanding that difference is the absolute key to not overpaying the IRS.
So first, let's just make sure we're all on the same page. What even is a restricted stock unit, or RSU? Well, think of it as a promise from your company. They're basically saying, hey, we're going to give you these shares of stock later. You don't get them right away. You have to meet certain conditions, like sticking around for a while. That's called vesting, which is really just a fancy word for when those shares officially become yours.
Now, to really get a handle on the taxes, you have to understand the three key dates in an RSU's life. First is the grant date. That's just when the company makes the promise. Nothing happens here, no taxes. Then comes the vesting date. This is the magic moment they actually become your shares. And ding, 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 this is our first taxable event. Finally, there's the sale date. That's whenever you decide to sell those shares, which, you guessed it, is our second taxable event.
All right, so let's break down that very first tax hit. This all goes down on the vesting date, that moment the shares land in your account and they are 100% yours.
So here's the most crucial thing to understand. The second your RSUs vest, the IRS looks at that and says, aha, that's income. The total market value of all those shares on that specific day is treated just like your salary. So if 100 shares vest and the stock is at, say, $50 a share, boom, that's $5,000 of ordinary income you have to report. And honestly, this is the absolute best way to think about it. Don't get bogged down in the stock market stuff. Just imagine your company gave you a cash bonus, but instead of putting dollars in your bank account, they paid you with company stock. And just like a cash bonus, you bet it gets taxed. And what kind of taxes are we talking about here? Well, think of it just like your regular paycheck. The whole gang shows up for the party. You've got your federal income tax, you've got Social Security and Medicare, and of course, any state and local taxes that apply where you live. It's all just treated as regular old compensation. Now, the good news is your company knows this is a taxable event, so they are required to withhold some taxes for you automatically. But, and this is a big but, how they do it really matters, and the default method might not be the best one for your personal tax situation. So the two most common ways this happens are called sell to cover and net share issuance. Sell to cover is usually the default. Your broker just sells off a few of your new shares right away to get cash to pay the taxes. With net share issuance, your company just holds back a few shares and pays the tax bill for you. For you, the end result is pretty much the same. You get fewer shares than you were granted because some of them were used to pay the tax man. And here is where a huge pitfall can trip people up. For supplemental income like bonuses or RSUs, the default federal withholding rate is often just a flat 22%. That's it, just 22%.
And just like our source material warns us, if your actual income puts you in the 32% or, goodness, the 37% tax bracket, that 22% withholding is not even close to being enough. And this, right here, is how so many people get that heart-stopping, shocking tax bill in April. They were being under-withheld on all year and had no idea.
Okay, deep breath. That covers the first tax you pay, the one at vesting. Now let's move on to the second taxable event, the one that happens down the road when you decide to actually sell the shares that you've been holding on to. This second tax is called the capital gains tax. The key word here is gains. It's a tax on the profit you make, and to figure out your profit, you need to know your cost basis. For RSUs, your cost basis is simply the market value of the shares on the day they vested, which, you'll remember, is the same value you already paid income tax on. And I need you to listen to this part very closely because it is the most important concept in this entire explainer. You are not being taxed twice on the same money. It's impossible. You're taxed once on the value of the stock when you got it as income, and then you're taxed a second time only on the new growth or profit the stock made after you owned it. It's two different taxable events on two different types of gains. Now, how much tax you pay on that profit all depends on how long you held the stock. If you sell it within 1 year of vesting, that's a short-term gain, and it gets taxed at your high ordinary income tax rate. But if you hold on for more than a year, it becomes a long-term gain, and that qualifies for much, much lower tax rates. So patience can literally pay off.
Okay, you understand the two taxes. Now for the most critical part, the part that actually saves you money. How do you report all this correctly on your tax return so you don't accidentally get taxed twice? Because this is where the trap is hiding. Okay, so let's look at the actual paperwork. First up, your W-2 from your employer. That income from your RSU vest, that market value on vesting day, is already baked right into the total wages in box 1. Your employer already reported it. You've already paid income tax on it. Done. You're all set with that part. But then you get another form in the mail, this time from your broker. It's a 1099-B, and it reports the sale of your shares. And this is where your heart might skip a beat. Because often in the cost basis column, it will say 0, a big fat 0. If you just plug that number into your tax software, it's going to think the entire sale was pure profit, and you will pay income tax on the whole amount all over again. This is the double tax trap in action.
But don't panic. Your broker sends you another document. It's usually called supplemental information, and this thing is your savior. It's your secret weapon. It isn't sent to the IRS, but it has the number you actually need. The adjusted cost basis, which is the real market value of the shares on the day they vested. So when you're filing your taxes, you'll use a form called Form 8949. And here's what you do. You report the sale exactly like it says on the 1099-B, but you manually go in and adjust the cost basis. You replace that scary 0 with the correct number from your supplemental form. That's it. That one simple correction properly calculates your actual capital gain and makes sure you only pay tax on the real profit. All right, you now know how to sidestep the biggest tax trap out there. So let's wrap this up with a few smart strategies to make sure you're getting the absolute most out of your company stock. Okay, 4 key takeaways for you. Number 1, seriously consider selling your shares right as they vest. It basically eliminates any capital gains tax and makes your filings super simple. 2, avoid having all your eggs in one basket. It's risky to have too much of your net worth tied up in one stock. A good rule of thumb is no more than 10 to 30%. 3, plan for that extra tax bill. If you know that 22% withholding isn't enough, set money aside or make estimated quarterly payments so there are no surprises. And finally, use the money wisely. Taking that cash and maxing out your 401k or an IRA is just a fantastic move for your future. So there you have it. RSUs aren't some scary tax trap you need to be afraid of. They are a powerful opportunity, a wealth-building tool waiting for you to use it wisely. Knowing what you know now, the only thing that stands between a surprise tax bill and a smarter financial future is a plan. So the real question is, what's your plan to make them work for you?